What's up, YouTube? It's Joe Catchpolia sitting on the couch making some money investing in fractional real estate online, as usual. Um, Today, I just wanted to give you a little update on Groundfloor. There's been some changes with the Flywheel portfolio since I first put out a video about it. I just wanted to update you on how that works. If you recall, until now, if you don't know what Ground Floor is, it's a platform where you can invest in small pieces of mortgages. I do have on my, if you go to my channel and look at playlists, I have a playlist that'll just show you all the Ground Floor videos I've done. Have one that just tells you what Ground Floor is in general, what the Flywheel portfolio is in general, and that's a little bit dated, and that's what I'm going to update. How to use the auto investor, how to use the investment wizard, all separate videos for those. There's also in the description to this video, I'll have a link to our Discord where it's just for a generic fractional real estate investors Discord channel where you can get together and talk to other people who are invested in Ground Floor or Lofty or Mogul, Arrived. I think there's some Landa investors on there, but Collab. Really, most of the platforms have at least somebody who's bought in on there. So if you just want to join that conversation, I also have links to any of the platforms that are fractional real estate sites that I've invested on. You might get some free money if you use some of those referral links. Some of them you won't. You just have to check on the site and with the link. And sometimes they end up dated. But as of right now, or at least a couple of them, you will make money, including the Ground Floor one. They do require an investment when you use it. But so let's just jump into it though. Up until now, I have been, when I put money into my account, I just spread it out over all of the available loans on here. I haven't been being picky at all. Um, and as loans repay, I just come in and do the same thing. I haven't been, and I've been doing that manually or using the auto investor and the investment wizard. I don't believe those have changed at all. So if you just go back and look at the old videos, if you want to try to use those, the auto investor just basically, as money hits your account, it just automatically will take, X amount of dollars and put it into, an available loan. And then if there's still money left over, it'll put it into the next one, into the next one. And so you can pick which grades of loans that you want money to get put into and the maximum that it will put into each one, and it will put that maximum into each one before it goes on to the next. So if you put a big number, it might all just end up going into one of the, and I'm saying loans, but these are actually LROs, which, it is you're getting essentially a piece of a mortgage and note when you have these. Um, and then, the investment wizard is if you have a chunk that you put onto the platform, like when I first put, sent a deposit, you want to spread it out across whatever loans are available, that's what you use that. But so the difference with the Flywheel portfolio is instead of doing that, the Flywheel portfolio, and I think when I did the initial video on it, I just said it was a REIT. But if you look at their FAQs now, it says it's set up as a series of REITs. And I think it makes a little bit of a difference because it helps you understand how it's working. So from time to time, and this is their SEC filing for it, you can read for the most recent piece. I think it's the most recent. You should definitely, you want to look at it yourself. I'm just have this up. But it describes, what their business is, the amount that they're raising, the types of loans that they're investing it in. They're all fix and flip loans or new construction secured by first liens on the underlying property. So that I think is how they are over time. Ending old ones and raising more capital in a new REIT. And so when you're investing in that portfolio, you might be investing in more than one REIT is how I understand it now, or maybe it's a single REIT that's invested in additional REITs. They do have a where is it? A little organizational chart or flow chart. Oh, where'd it go? In this, you can see obviously there's a whole bunch of info that you should read. Some of these, sometimes when you get into these filings, they're very technical. Did I think I had already passed it. Or I have the wrong one open, and I'm sorry if that's the case. But I bet it's all the way at the top, because I don't remember going all the way down here. I'm sorry about this. And there we go. So it's, you can see how it's actually working here. And I think over time that you'll end up with, like, this is Groundfloor Loans One LLC. I think that they'll just continue to create additional REITs. I'm not positive that's what's going on. One of the reasons that that's important is, um, so there's a couple of advantages I think of the Flywheel portfolio that I hadn't really thought about before for other investors. So one, they're making their payouts on a weekly basis, and it's payments, um, that occur as the loans are repaid in the portfolio. Well, if you went in here today and let's say you spread your money out over all available loans, you might only get 20 or 25 loans or something. If you went in here the same day and invested in a Flywheel portfolio, this is actually the portfolio you get a piece of, and it has, what does it say, the total there? You'd have to add those up maybe to get the total. I thought that I saw it somewhere, but around 300 loans, right? I mean, that's just a little over 300 loans, it looks like, that you're getting in to invest in immediately. So you get, um, over time, you're getting to diversify instantly, instead of, like, it's taken me 6 months to get to. I think I have 112 loans or something like that. Let's see how many I actually have. I gotta go to my reporting tab. LROs. I think I might have already just seen it there, but let's see. And I just want to look at my open projects. I have 115 performing into extended, so 117 loans. It's taken me about 6 months of diligently, allocating my repayments to that. One of the things I think that's interesting that they've done now is added this annualized return amount, um, which is nice because it shows, how I'm doing so far on my investments. I just got a little pop up today that this was new. I hadn't seen it before. Um, but anyway, so in 6 months, I've got less than half of the number of loans that they have in their total portfolio. And so that's one of the big advantages, right? Is that they have that right away. And so over time, and your repayments, the way they happen, if I own individual LROs, when that note pays off, I get a payoff. And so it can be pretty chunky, and there'll be some weeks where I don't get any, and there'll be some weeks where I'll get quite a few. For me, it doesn't really matter because I'm just reinvesting it whenever it is. But if you were going to put a lot of capital in here and then count on the income from it, um, I think I'd rather get weekly payments, but it still doesn't guarantee you're going to get the same payment every week. It's just based on the repayment of the underlying loans. And so all of this info I'm just getting from their website, from their FAQs. But it just wasn't super clear to me at first of some of these things, so I just wanted to point them out. Um, this is one of the big changes from the time that I did the first video, is their fees are different. So I've referred to their fees as being 1%. I'm taking the time to spread out the loans to avoid that 1% fee. And that was, it was a quarter of a percent that they charge for your total assets under management. Um, and they did it quarterly. And so that actually ends up being a little more than 1% because you're compounding quicker, but it's essentially 1%, right? Now, instead of doing that, they're doing a half of a percent of each disbursement. So they're basically lowered, um, the fees that you get charged on this, which I think is pretty good, especially because they're doing it on disbursements. And so, um, well, I guess it doesn't compound within in it. I don't know. It seems like it. They say this is lowering your overall fees. I believe it, and it seems like this is a step in the right direction. But then they say that their net target return, so your return after fees, is between 8 and 10%. Where before it was they were quoting a little bit higher number than that. I don't know if they're starting to expect more losses, right? Because their average interest rate is higher than that, but then that's after the fee, and then after any losses. So loans that don't pay off in full. But I thought this is interesting that this number's gone down, even though the fee that they're charging has gone down. Um, okay, this is where they're just talking about, why is it more diversified than the auto investor? And that's just what I was talking about, right? It's automatically buying some of all of them, just like what we're trying to do, but you're getting to buy into all these existing ones immediately. And then the other thing is that they do mention that, I don't know if it's on here or somewhere else, but that they mention that they don't just buy into the LROs, sometimes they're buying into the notes itself. And so there is a section um, where you can buy whole notes. I believe to do this, you need to be an accredited investor. Maybe not. I'm not sure. But you can buy whole, pieces, or you can buy whole notes, I think, on here. Maybe, or maybe pieces of it still. I'm actually not sure how these are different. Because when I looked at this before, I was under the impression that you were, um, hmm, I don't know. But so, it might be buying some of these as well. And so I don't know, you'd have to dig into it. I haven't bought any of these, which is why I'm not up to speed on what they are. But so some of those might be in the Flywheel portfolio also. Um, but then the other thing is that they've mentioned, and I think I mentioned this in the first video, but they're set up as a REIT. And they say you might be eligible for this 20% deduction under current federal tax law. So again, I'm not here to give you any kind of investment or tax advice. I'm just telling you what I'm doing and what how I understand what they're doing. I know I always give this disclaimer, but just because I invest in this platform in a certain way or in particular notes doesn't mean that you should do it, right? You want to do your own due diligence on all this stuff. That's why most of my videos are about how I do due diligence, the things I'm looking for, and just to help you think through like how you're looking at it. But I'm definitely not telling you, hey, I bought this, so you should too, right? I mean, I'm showing you what I'm doing, my thought process as I do it, but you definitely want to understand this stuff on your own, do your own due diligence, and then also, especially for the tax stuff, you want to get your own, get your tax advisor to weigh in. It does look like for me, this is going to be if I had all my money in this, at least for this this tax year, that I would have been, or I would be better off having invested in here than in the individual ones, assuming my returns end up being the same, which. Um, Even with that 0.5% fee, it seems like it should be. It seems like it will be the same, or seems like it will be pretty similar. Um, but they mentioned this tax law is set to expire, and so who knows if that's going to continue. But between this and the instant diversification and the fact that it's so many notes and you should get weekly payoffs, and so um and actually the on the flip side of the weekly payoffs, some weeks I'm getting like three or four that pay off, and then I go in and I reinvest them, and I could just wait until they're in there or just let the auto investor do its thing. Um, but I don't know. I think there's some benefit to just having that weekly. I think with all that, I'm getting close to wanting to go in that direction versus just continuing to do what I'm doing, where I'm buying the individual LROs. Uh, And as far as what they've said on their platform is they're going to continue to let you do either. I think if you're a new sign up, you will only see the Flywheel portfolio, but you can ask them to set you up with what they call an investor account, and so you can go and buy these LROs instead. If you've tried that, let me know. I'd be interested to hear about it. In our Discord, there was some discussion on it and a link to it, but because my account was already set up, I don't know that it's worked for anybody else yet. Um, but so for me, I just really like to have the control about, even though I'm not doing a ton of due diligence on any of these right now, I am just buying pieces of every single one that they put out. Um, I like that. I'm just always a little bit nervous whenever you have a fund or REIT structure. And I'll give you an example of why. So like this REIT, where is it? It's going to be down below, I think. Uh, when they raise the capital for it, well, let me just do that. 7.5. Um, Sorry, navigating this is always a mess. But so when they raised the capital for this, they had it probably looks ridiculous having to look at it because I think um, well, there's like $100,000 in expenses that are rolled into the 75 million. Now, that's a pretty small percent, right? Like it doesn't even make up a single percentage point. But that's one of the things that once you have this REIT structure, you have to start to dig into what are the expenses at the entity level of the REIT, where when we have these individual LROs where it's just okay, I just have this note, it's just this interest rate. There's not some additional baked in fees. It's just something I'm really paranoid about because I started my career working at two different public REITs, and I could see there was just a lot of waste at the REIT level, right? Like in the management structure and the expenses built into that. And it doesn't seem like, I think this is, what would be referred to as an externally managed REIT. I'm actually not 100% sure about that. Um, and so you end up don't not having that necessarily. But at any time, the whole reason that I'm into the fractional real estate investing in general versus REITs, just to get that same real estate exposure, is because I think that if we use our real estate knowledge and we're picking properties, not so much on ground floor, but on most of the other platforms, I'm doing a lot of due diligence on individual properties. And so I like to really understand what it is that I'm investing in. And so the more it becomes a structured finance type investment, the less well I'm going to understand what's going on. And I think that that just leads to a situation where I could end up paying a whole bunch of fees that I don't realize I'm paying. I could think that I'm going to get certain returns, and that reminds me, I want to talk about. So I put this thing out, and this was over a week ago, but it was just like what can I expect from returns? I think there's some errors in this. But they're talking about the loans in the Flywheel portfolio have 8 to 15%, but average 12.5%. Um, Historical loss ratio of 1%, and then they're saying that targeting 8 to 12% net of fees and expected losses. But then they go into this historical stuff and they say, okay, if you look at our performance over the last 3 years, we've been at 10.8% realized return on loans. And they say, this is based on loans from 2022 to 2024 offered on Groundfloor and resolved as of basically now. And then they say, okay, but loans that were originated in the last 5 years, and they give a lower amount, but then they give the same date range, right? 2022 to 2024. So I think this is just a typo, right? Like they're just not doing it right, or I just don't understand what's going on. I don't know. Um, I don't understand how they get 5 years, right? Like if they're still just doing ones in the state range. But one of the things, why are these so different? I think there's a couple reasons. I think one is interest rates have changed over that time period, right? We had rates moved up quite a bit in 2022, but I also think that the longer that you hold a portfolio like this, the more losses that you're going to have because some of the delayed payments become losses later on, and so I can imagine that drags down your average return over time as well. And especially like if you look at okay, well, if you look at our flywheel portfolio, it's doing even better, right? But we have a shorter period of time, and so you'll have less baked in losses here because you won't know, right? It's too early to know the ones that were going to be losses. Um, so I'm really curious if we're going to end up more like this, or if a lot of this 8% happened because interest rates were lower at the time. I wish this wasn't giving you the wrong date range, so I could be a little bit more confident in this. Um, but one of the things is I've passed up on investing in the Arrived Homes Private Credit Fund because their current dividend is like 8.1%. But if we are now targeting in the Flywheel portfolio 8 to 10%, um, all of a sudden, sorry about that. I just had my screen recorder freeze, but I just was saying, now that the we're targeting 8 to 10% returns in the Flywheel portfolio, comparing that to the Arrive Private Credit Fund, it starts to seem like okay, we're not doing that much different, right? 8.1 versus 8 to 10. Um, at the moment, one of the big differences between the two is I think I saw earlier this afternoon that the Arrived private credit fund only has like 55 loans in it compared to about 300. But over time, you'd expect them to get more and more as well. Um, but again, 8.1 versus 8 to 10, hopefully we actually get higher than that. So I don't know. I'm not sure, and especially where, my current, where did that go? My current performance is 11.1% annualized. Um, I'm not excited about the 8 to 10. Well, maybe as I get more losses, I'll move down there. I do think it's still, even at 8%. I mean, it should be in my mind a good risk adjusted return. I mean, we're talking about first mortgage positions. Ground floor does have quite a long history relative to a lot of the other fractional real estate investing sites, anyway. Um, but overall, I was hoping to do a little better than that. Double digits, very low double digits, but hopefully 10 to 11, I was thinking. So I don't know. I mean, that's uh a- as it goes lower and lower, it'll be a less attractive vehicle for me. But it is, for someone who's much more concerned about their yield and having it be a safer yield versus being more worried about, your total returns, well then, I think it could work for some people. I'm definitely still going to keep using it. I'm going to see how it ends up. Um, but that's about it for today. I think that if you haven't already, please like and subscribe. Please join our Discord, jump in there, start a conversation about what you're doing. Do the 52-week challenge with us. If you don't know what that is, just check that out in there. In any case, until next time, I'm going to keep making mistakes so that you don't have to.